Okay, good afternoon and welcome back everyone to our Thursday afternoon webinar session. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're going to be talking about a very important topic, which is how to manage your options positions. We get a lot of questions around this type of topic. I certainly get a lot of questions and emails from members asking me about their positions and how they should go about handling it. I will say probably 95% of those questions involve a trade that has gone wrong. And the question is, how do I repair it? How do I get myself back to break even? How do I turn this trade around? And many of the questions that you guys submitted for review today are along those same lines, which is why we want to spend a little bit of time. Now, the tricky part about this particular topic is that it depends on your scenario. It depends on your strategy. There are different rules for different things. So what I want to do is I want to first start by talking a little bit about the overarching philosophy that you should bring to managing your options positions. Then what we'll do is we'll break it down into specific strategies, namely around how do you manage your risk and how do you prevent yourself from being in that place to begin with, in terms of in a position where you have a huge loss and you're trying to figure out how to get yourself back to break even. We're going to revisit a topic that I discussed here about a month ago on how to on trading philosophy and really just risk management in general. We'll start off with that, and then we'll talk a little bit about how you can utilize trades that are going in your favor and turn them into huge home runs. So we'll talk a little bit about those types of strategies and how to set yourself up for that potential upside. But in order to do that, you must first control your downside. So those are the things we're going to go over here today. Now, before I do, just a quick disclaimer, what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today, we're going to start off by talking about that position management philosophy. I think it's so important that before we talk about specifics in terms of strategies and how to repair your strategy and things like that and what you can do to improve your returns, we must first take a step back and really understand kind of how you should even be thinking about your positions. And again, this is something that we talked about a month ago. I hope many of you did join us for that particular webinar where we talked about risk management. We talked about the difference between infinite versus finite game and understanding which game you're in, because that sets up your mindset as to how you even think about these winners and losers in each individual trade. And it's so important in determining your plan for trading. Then we'll talk a little bit about how you can keep your losses small, because at the end of the day, that is the key to trading. If you ask any professional trader, anyone who trades for a living, what do they focus on? They're not focused on indicators. They're not focused on how do I make the most money. They're focusing on minimizing losses. So it's so important that you understand how you can minimize losses in your portfolio, because if you don't do that, you're never going to be able to set yourself up to hit home runs. And we'll talk a little bit about how you can hit home runs, how you can hit these astronomical returns on some option strategies, but it involves first making sure that you keep your losses small, and it all involves reducing risk. And I will cover a little bit about cover calls and short puts, because these are two strategies that are, I would say, on the side, because these are two strategies that actually decrease risk in your portfolio. So the portfolio management of cover calls and short puts are separate from all of the other rules. And then we'll go through a few different examples before we go to Q&A. And so many of you submitted your questions before the event. So we're gonna focus on those types of questions and making sure that we address those at the end. So those are the things we're gonna go over here today. And I'm gonna start off with a quote, because this quote, in my opinion, represents what many of us feel or represent a lot of the questions that I receive every single day, including the questions that I received today for this particular event. And it always runs along this same line of, I place an options trade, it's now turned against me, and what can I do to turn this into a winner, right? And if you can relate to this, please type 1 into the chat window if you've ever been in this type of scenario. And I think every one of us that's a trader can relate to this, right? We've placed an options trade, it doesn't work out, and we're trying to figure out a way, how do we get back to break even? And I will say that this is really where I think most traders go wrong, is thinking about losing and not wanting to lose and getting attached to getting yourself back to break even, getting yourself back to being a winner, right? Because we think that if we win a lot, we're going to be profitable. And it's really important to remember that those two things are very different from each other. You can win all the time and still lose money. A lot of times we associate winning with profitable, and that's not true at all. So it's important to understand what should you focus on. And this is something we spoke about a few weeks ago. So it's really important that we discuss this again. So I brought up this example last time, and then for those of you that joined us, forgive me for bringing it up again, but I think it's so important for us to utilize this as an example, which is, let's say you have a stock and the stock is trading above this $26 level, and you see that this $26 level is support once, support twice, and you see it touch that support again. So you're thinking to yourself, okay, this is a good trade for at least up to that 28, 29, 30, 31, 32 level to the upside. You're thinking that this is a great trade. There's clear support here. And, you know, from a technical perspective, I couldn't disagree with you. But what happens after you buy the stock? Instead of, it moves higher initially a little bit, but afterwards it starts to move lower, right? And at this point, what should you do? I know many traders who will, at this point, will say, okay, well, this trade didn't quite go in my favor. I have a small loss here on this particular trade, but let me look at this trade again. It didn't quite work out in terms of the $26 support, but let's look back a little. There seems to be pretty strong support here around 22. So you think to yourself, okay, well, the $26 support didn't hold, but maybe the 22 will. So let me buy a little bit more of the stock, or maybe buy another call option, or whatever strategy that you're trading. And you say, well, if I buy a little bit more and the stock bounces off of that support level, I can get myself back to break even and get out of this trade and not lose any money on this trade. So you buy a little bit more, and what happens? The stock continues to move a little lower. And at this point, you're starting to get a little frustrated. Perhaps you're losing a little bit more than you intended, but it's not a disaster yet, right? So then you start thinking about, well, it failed at the $26 support level. It failed at the $22 support level. Maybe you like the stock from a fundamental perspective. So you say, well, okay, at this point, the RSI is so oversold that it must bounce, right? It's oversold, it's got to bounce. So you buy a little bit more, thinking, well, let me just do this one last trade and hope that I get myself back to break even. Now, I think, again, many of you may find yourself in a situation where you've done something similar, right? Please type 2 if you have traded something similar. And at this point, what you might, by the time you're on the third trade and the third trade doesn't work out, guess what happens? Now you're getting desperate. Now you're saying, wow, I've really risked substantially more money than I intended to, and there's really no way out other than kind of going full boat, if you will. I'm pot committed now, as poker players say. I'm pot committed. I have to be able to get myself back to break even. So you buy a little bit more because you're thinking, well, it's been oversold for months now. It's got to bounce. And you get that kind of bounce, but the stock doesn't really rally quite enough for you to get back to break even. It continues to move lower. And depending on how much you're buying each time, this could spell complete disaster for your portfolio, or at least eat away a lot of your gains and create a substantial loss in your portfolio. So many of you commented that this is a position that you've felt that you've been in before. Some of you said that, you know, this is what you used to do. You no longer do it because you've learned your lesson. And I'm glad that you guys did learn your lesson. As traders, we tend to call these types of trades tuition. This is learning how to trade. So today, what I really want to talk about is really how do we prevent this? How do we think about our portfolios to prevent yourself from being in this scenario? And this is something, again, that I spoke about 3 weeks ago, and I think it's so important to bring up again. It's a concept brought up by a religious philosopher of all people, and he came up with this idea. He came up with this theory that there's two types of games. There are finite games and there are infinite games. Finite games are the games that we are all familiar with. They have fixed rules to the game. The game ends at a certain point, and at the end of the game, we declare both a winner and a loser. An example of this is football, basketball, blackjack, chess. These are the types of games where you have a set of rules, and at the end, you know exactly who wins, who loses, and at the end, there's an end to the game. And then there are sets of games that we call infinite games. These are games that have no agreed upon rules. The game never ends, And at the end, or technically there is no end, but you effectively have two types of players. Players that can still continue to play because they are still in the game, and players who drop out because they no longer have the will, they no longer have the money, they no longer have the ability to stay in the game even though they want to. So if you think about what types of games fall into this type of category, and this is really where once you make this delineation between left and right, that's when it really changes kind of your thought as far as how you approach trading. Because, for example, football is the name of an infinite game, but running the National Football League is an example of an infinite game, because there's no such thing as winning in the National Football League. You can't win owning the football league. You can only continue to operate as a league until someone else potentially comes along and creates a better league and pushes you out, right? Think about it. The National Football League is by far the dominant league in the United States, but there are other leagues out there. They're barely hanging on by a thread. No one really watches them in comparison to National Football League, but they exist, right? So until one of these other football leagues become bigger and squeeze the National Football League, the National Football League, for all intents and purposes, is the winner, and the losers are the smaller football leagues that maybe are being squeezed out of the game. Starting a business, same thing. There's no such thing as winning in starting a business or operating a business. You're either in business or not in business. And guess what? Trading is the exact same thing. You either have a trading account with a portfolio with enough capital to continue trading another day, or you've blown up your account. You cannot trade anymore unless you deposit more money. And once you realize that trading is an infinite game, what you realize is that your primary focus is not on winning. Winning doesn't matter. Your primary focus is making sure that you don't drop out. Once you drop out, guess what? Game over. So when you do that, when you realize that you're playing an infinite game, that's when you focus your attention not on how do I win each trade, you focus on how do I become profitable, or more accurately, how do I focus my attention on not blowing out my trading account? So we covered this in a lot of detail a few weeks ago, but just to give you a quick overview of what we discussed and how to actually achieve that, the answer to that is actually really incredibly simple once you understand that you're trading an infinite game. And that is that never risk more than 1 to 2% of your total account per trade. Now, someone did submit a question for this session asking what are my rules in terms of what percentage or what dollar amount of my account that I should risk. And the rule of thumb here is 1 to 2% of your account. Now, many of you joined us for that session. We went through the math. We went through a lot of the process as to why we want to choose 1 to 2%, but it's really important that we understand that we're trading an infinite game, and in order to stay in that infinite game, we need to keep our losses small. And if we keep our losses small, we can always continue to trade another day, okay? So that is the first and foremost, the most important thing to learn as an options trader in terms of how do you manage your options positions. This has nothing to do with specific strategies, specific criteria, or specific trades, but just the philosophy that you bring to managing your options positions. Now, I want to make sure everyone understands this before I move on, so please type 3 into the chat window if this type of thinking makes sense to you. Okay, perfect. So, along these lines of how do you keep your losses small, the answer to that is that before you get into every single trade, you should have generally 2 plans ahead of time, meaning these are things that you should have planned before you even enter a trade. And that is, how should you exit that trade and when should you exit that trade? If you don't know when you should be exiting that trade when you enter the trade, guess what? It's going to be very difficult for you to keep your losses small. You need to know exactly when you're going to exit before you get into the trade. And there are 2 different types of trade plans. One is what I call a trade thesis plan, and another one is a plan based on your P&L of your position. So a trade thesis plan is basically, why did you get into that trade? So for example, in this example that I showed you in the first place, I got into this trade because I identified that $26 was a support level. That's your thesis, right? Your thesis is that $26 will hold, and I think the stock will rally up to, let's say, $32. Now, the second that the stock breaks below that support level, that is your that is the market telling you that your thesis is wrong. And it's important that you know when you're going to switch from when is my trade correct and when is my trade incorrect. So you should know ahead of time why you're getting to the trade and whether or not at any point that you can evaluate, is my trade still correct or is my original thesis incorrect? Guess what? If your trade is correct, that means you can stay in the trade, okay? If your trade is incorrect, guess what? That is your signal to get out. So in this particular case, if I was in this original trade, when the stock broke below that $26 level, that should have been your signal to say, hey, I'm wrong on this particular trade, I need to get out, because my thesis was that $26 is a support level. It's no longer true. Get out. Now, would you get into another trade on this, on the back of that, because you think $22 is a support level? That's possible. You can get into another trade, but what you need to do is you need to first exit your first original wrong thesis, and then if you want to place another trade, another different thesis, you certainly can, because then at that point, if the stock then breaks below 22 again, guess what? Your thesis there is again wrong. Now, at this point, you want to make sure that each trade is emotionally detached from the last one, because when we buy some, get into a trade, buy some more to get back to break even, and by the time we get to the third or fourth trade, guess what? We're emotionally attached to that trade. We want to remove the emotion from the trade. And how do you do that? Is by having a thesis plan, understanding when you're wrong, when you're correct and when you're wrong, and being able to get out of a trade either at a profit or a loss. The second thing that you can do, which is sometimes, in my opinion, actually a little easier from an emotional perspective, is to simply have a plan based on P&L. And I'll show you some examples as to why the trade thesis plan sometimes is difficult to stick to, especially when your thesis is more on the fundamental side. It's difficult to say, am I wrong or right based on fundamentals? So I'll give you an example of a mistake that I made recently and how I could have corrected it, okay? So the easier way, in my opinion, the more objective way, is to look at your P&L. And generally speaking, what you generally want to do is cut your losses at a certain threshold. Now, again, this depends a little bit on the strategy itself. So certain strategies will have different thresholds, but the general rule of thumb here is that when you lose 50% of the premium that you've paid for an option, it's time to get out of that trade. And you never want to double down and increase your portfolio risk because a trade is going in against you and you're trying to get yourself back to break even. Because when you're trying to get yourself back to break even, what you're focusing on here is winning. And guess what? Winning is something that you can only do in a finite game. There's no such thing as winning in an infinite game. In an infinite game, you're either in the game or you're no longer in the game. And if you keep trying to get yourself back to break even, what you're doing is you're potentially putting yourself in a position where you can potentially drop out. Because if you keep adding risk to a losing position, guess what? That is the recipe for blowing up your account and having to drop out of the game. And that's what you want to avoid at all costs. So I just want to make sure everyone understands that. Please type 4 into the chat window if this makes sense to you. Perfect. Okay. So with the P&L, because the P&L is a number that you can't fake, it's something that you can't make up. It's exactly calculated based on where the market is currently trading. These are, generally speaking, in my opinion, sometimes better rules to follow, because you can't break them, right? You can't say, well, I'm almost down 50%. You're either down 50% or you're not down 50%. So when you use rules like this, they become a little clear cut and easier to follow. And what I'm really going to spend a lot of time on is talking about taking partial profits when possible and showing you how to roll your positions either up or out and extend your targets or extend your time, or even extend the magnitude of a specific trade to allow you to really hit these types of home runs. Because if you can keep your losses in check and then have the strategies to roll up and out and roll these types of strategies like the ones that we're doing with Zoom in this particular trade, that's how you're going to be able to hit home runs. And that's what we're here to talk about here today. So what I'm going to do is I'm going to give you some examples of how you can hit home runs, meaning how can you take a winner and turn it into a massive winner? Because when it comes to taking losses, there really isn't any strategy around taking losses. I do have one example of when you can potentially turn a loss into a gain, but I think the one thing to remember is that anytime that you're trying to turn a loss into a gain, in order to do so, you have to take on more risk. And it's never a good idea to take on more risk for a losing trade just to get yourself back to break even, because again, you're putting yourself back into that mindset of winning and not in the mindset of playing an infinite game. So be very wary of strategies that quote unquote turn a loser into a winner. But I will show you some of the things that you can do that does not increase risk by much and could potentially turn a loser into a winner, but they're only suitable for very specific types of strategies. So I will show you an example of that, I promise you. So but most of the time that you can really turn a small, a winner into a huge winner really is regarding trades that are starting to work in your favor, right? So even if you have half the trades work against you, meaning half the trades that are losers and half the trades being winners, and you're thinking to yourself, well, that's a recipe for zero, guess what? If you can just keep your losers to losing the exact amount that you originally intended to, I'll show you how you can turn your winners into potentially very large winners so that you become a profitable trader. Okay, so what I'm going to do is I'm going to give you an example, and I think Zoom, the trade that we just made on Zoom, is an example of how you can turn a small winner into a potentially a huge winner. So let's say I'm buy 10 calls of a $100 stock. So let's say I have a $100 stock. I think the stock's going to go higher. So I buy 10 contracts of the at-the-money call options. Let's say those call options cost $3. So the total trade that I'm making cost me $3,000 to get into this particular trade. And I have a target price of 110. I think the stock's going to rally to 110. So I buy the at-the-money call options for $3. And let's say after I buy these calls, the stock moves up half the amount. It doesn't move up all the way up to 110. It moves up to, let's say, 105. So I got the direction correct, but I didn't quite get the magnitude fully. But it did go in the direction that I expect, and I still have plenty of time left. In this particular case, let's say I buy, I don't know, a 2-month option, and 3 weeks before expiration, the stock's at 105. I think that it can still continue to move higher, but it hasn't quite reached the target that I expected to. So what can you do here? What can you do to continue to play for upside, but do so in a way to further reduce your risk? Because the goal here is to really reduce your risk. So one of the simple strategies that you can do is to simply close half of your position, take some profits, and leave the other half to still maintain that full upside. So in this particular case, let's say the stock goes up to 105 3 weeks before expiration. What I can do is I can sell, let's say, half of my call position. So I have 10 contracts, I sell 5 of them. Because the stock rallied from 100 to 105, those call options are going to be worth more. Originally, when I bought them, they were $3. Now they're worth $6. So by selling half my position, what I bring in is a $3,000 credit. Now, my original trade was a $3,000 debit. So just by closing half this position, what I'm doing is I'm reduced my overall risk on the entire trade down to 0. So what that means is that I still have half the position remaining. I still have 5 contracts left that currently is worth $3,000. Now, I can certainly take that and take the $3,000 profit and walk away from this trade with a $3,000 profit, and that would be a great result. But what you can do is you can really turn this into a big winner if the stock does continue to move higher from 105 to 110 or even further without risking a single dollar. Because by this point, once you close out half your position, you've now taken all the risk off the table. You can take that $3,000 and apply it to another trade if you'd like. But in the meantime, while you apply that trade while you apply that $3,000 to another trade, you still have half the position potentially working in your favor. Now, yes, this trade can now turn around and go against you. And guess what? You make 0 on this particular trade. But what also can happen is the stock can move substantially higher. And what happens is now you have that position effectively for free because you're keeping the other half of your position. You're not paying any money. You're not having any risk on that particular trade. And usually when you do this, you either reduce the risk on the trade or you could potentially have no risk at all on the remaining trade. And I have some examples where you can even do this where you are net, where you're bringing in is actually a net credit to the whole trade. So maybe sometimes the trade goes so far in your favor that you actually can bring in a small profit on the trade and still maintain half the position to allow you to continue going higher. Now, this strategy does require you to have at least 2 to 3 weeks remaining, meaning you need to have enough time for this trade to still continue working in your favor. So that is the first strategy that you can deploy on a simple strategy like buying a call option. You can also do this on a debit spread. You can also sell call options against it, but those are all strategies that will limit the upside. The goal here is not necessarily to limit the upside, it's to reduce your risk substantially, but still allow you to take advantage of that further upside. There are lots of variations to this as well. So you can close out half the position and then sell, maybe a 120 call against it. So, I think there were a couple of comments regarding can I buy calls? So can I sell calls? There are small variations that you can do on this, but this is meant to give you an understanding as to how you can turn what is a small winner into potentially a huge winner. Because if, let's say, this stock continues to go up to, let's say, 110 or 115, now you're talking about maybe another $6,000, $7,000 in profit on a trade that you risked $0 on. That's the type of home runs that you generally want to try to hit. And if you can continue to manage your losses so that your losses are small, and once in a while you hit these home runs, that's how you become a profitable trader. Okay, so does that make sense, everyone? Please type 5 into the chat window if this example makes sense to you. Okay, perfect, great. I see a lot of 5s. Let's see. The next example I have is a similar example here, where let's say I buy I need a time, this is what we call a time extension. And this is a scenario that, again, many of us sometimes find ourselves in, where we buy a call option. In this particular case, let's say I have a $100 stock. I think the stock is going to rally to, let's say, 110 by a certain time. Let's say in this particular case, my time frame here is July. But then by, as we approach July, the stock hasn't quite hit it, but I'm still bullish. And I think that now I need another month. I think that maybe some type of event or some type of catalyst event that I was expecting got delayed. And I'm expecting that now I'm going to need a little bit more time in order for me to hit my target price. So you're thinking to yourself, well, I need to buy myself more time. And you know that when it comes to options to buy more time, you have to spend more money. You have to risk more money. So here's a strategy that you can utilize where you can extend that time without necessarily spending any more money. So let's say I buy this July call option. I buy 10 contracts of it. It cost me $3 a call option, and it cost me a total of $3,000 for the 10 contracts. And I have a target price of 110. What happens is I get a modest directional move to 105 in, let's say, 3 weeks' time. And I'm thinking to myself, in order for it to reach that 110, I'm not quite comfortable. I don't think it's going to get there in 3 weeks. I think it's going to take longer, right? So just like the same example that I gave you before, but here you're not as confident in that big push higher. You're thinking that it's going to take a little bit more time. So what you do is you sell all 10 contracts of the July 110 calls. In this particular case, just like before, these call options are trading $6. Instead of selling half your position for $3,000, what you do is you sell your full position for $6,000. So net, what you've done at this point is that you've made a $3,000 profit on the trade, right? You've made a $3,000 profit on this trade if you just simply exited this trade and walked away. But you're thinking to yourself, well, I think this thing can go higher, but how do I play for that a time extension without risking more money? And the answer is, what you can do is you can go to the next month, buy the same call options, but because those call options are going to cost a little bit more, let's say the August options, instead of costing $6, cost $7, what you're going to do is you're going to buy the August $100 call options, and instead of buying 10 contracts, what you're simply going to do is you're going to buy fewer contracts. And the goal here is to make sure that you're not paying more than what you're bringing in terms of selling those July options. So in this particular case, maybe you're only able to buy 8 contracts of the July ones, But what you've done is you've basically bought yourself a little bit more time without adding more risk. You're actually taking a little bit of risk off the table here because you received $6,000 in credits, but you only spent $5,600 to buy these August calls. So you've reduced your total risk from $3,000 down to $2,600. Not a significant reduction in risk, but what you've done is you've bought yourself a whole nother month in time while taking on $400 less in risk. So that never happens, right? Because normally for you to buy a longer dated option, you have to add more money, you have to risk more money. Here, you're actually bringing in a small credit. So this type of strategy allows you to extend your time in order to reach the target price that you have on the underlying stock. It decreases the leverage a little bit because originally you had 10 contracts, now you only have 8. But what it does is it typically does reduce some of your downside risks as well. But what you're doing is you're trading off a little bit of leverage for some time, right? So, the beauty about options is that you have so many options. It's so flexible in terms of what you can achieve. It really comes down to your imagination and what you can imagine. And this is just meant to give you a template as far as the different things that you can do with options to buy yourself different types of payoff graphs. And this is just, again, giving you an example, because I could also, instead of buying 8 contracts of the August 100 calls, because the stock's at 105, maybe I can buy 10 contracts of the August 105 calls. So I can actually make sure that I don't decrease my leverage by buying a higher call option. You obviously have a higher break-even price at that point if you do so, but this is really where you can play around. You can test out all these different scenarios, and OptionsPlay is really designed to help you explore these different types of scenarios so that you can take these types of examples and take them as kind of just inspiration for trying different things, because there are lots of things that you can try. So this is one way that you can buy more time and do so in a way without adding more risk to your portfolio. And the one thing that you'll notice, the theme across the board here, is doing all of these things by not adding additional risk. And most of these trades are actually reducing your risk. And that's how you truly hit home runs in the long run. Okay, so does everyone make sense? Does this make sense, everyone? Please type 6 into the chat window if this makes sense. Okay, perfect. I see a lot of 6s. Lastly, what I want to do is I want to talk about what if you hit your price target and you think the stock can continue moving higher? I think Tractor Supply was an example of this trade. Zoom was an example of this trade. There are plenty of examples that are examples of this particular trade. And the question is, how do you take some risk off the table and continue to play for substantial upside? So here, what I'm doing is the same example. I'm buying 10 contracts with a $100 call option for $3, costing me $3,000. In this particular case, I have a $100 stock that I think is going to rally up to 110. So I buy the call options because I think it's going to go higher. And let's say within a week, I get this quick move to the upside and the stock goes up to 108, much quicker than I originally anticipated. So maybe at this point, maybe some news came out, right? Maybe some new information came out that I didn't have originally when I bought the original call options. And now I'm not only am I bullish on this, I'm even more bullish. I think it's not only do I think it's going to go to 110, I think it's going to go to 120 or 130, right? Think about Zoom, right? When I first brought up the stock, it was trading at 100. It was trading at some pretty crazy valuations, and I will say that, last earnings quarter, I was quite hesitant to pull the trigger on a call option on a stock that was trading at crazy valuations. We didn't know COVID-19 was going to turn into what it did. But the only way to trade that is using a call option to reduce my risk to the downside. And I had no idea the stock was going to go to 130 and then quickly go to 150 and 180. I just simply did not know that was going to happen. But when it did, I was able to utilize these types of strategies and change my risk to reward substantially and turn that, what I thought was going to be maybe a 60-70% profit on that trade to a 1,000% profit on that particular trade using strategies just like this. And this is just, again, one of what could be thousands of variations of how to achieve this type of strategy. So what happens is when you get a quick move to the upside and you still have a lot of time left to go, and maybe you have new information, you think the stock's going to continue moving higher, what you could do is you can sell your original trade. So I sell 10 contracts. Now at this point, because the stock made a big move to the upside, my call options are worth substantially more. So what I do is, let's say I sell this full trade for $10,000. So my net profit at this point already is already $7,000 at this point. But because I think it's going to continue moving higher, I want to try to turn this $7,000 trade into maybe a $15,000 or $20,000 trade. And again, if you keep your losses small and once in a while you hit these home runs, that's when you become profitable as a trader. So what I do is, instead of just selling these 100 calls and walk away with the $7,000 profit, what I can do is I can then, and you don't have to do this, but you can now say, well, I'm going to buy 15 contracts with the 110 calls, because at this point I can spend $7,500 to buy 15 contracts. So I'm increasing my leverage. I'm buying a higher call option, and it only cost me $7,500. Remember, I'm bringing in a $10,000 credit to sell these contracts, and I'm only spending $7,500. So now what I've done is I've taken almost all of the risk off the table. My only risk on this entire trade originally was $3,000, is now only $500, because I made a $7,000 profit and I spent $7,500 of that to buy 15 contracts. So now, yes, I didn't make a profit on this trade yet, but now I'm only risking $500, and now I have 15 contracts. I have even more leverage. So if this trade now goes from 110 to, let's say, 118, guess what? I'm now looking at roughly another $7,000, $8,000 profits, or maybe, whatever roughly that profit is. But instead of risking $3,000 to make a $7,000 profit, my total risk on this particular trade is only $500 to make, let's say, another $7,000. And that's when you start getting into the realm of hitting real home runs of 1,000% returns, 1,500% returns. And only you can do this when you can utilize options in this particular strategy. And most of the time we don't even think about how you can leverage options in this particular manner, but this is really how professionals think about trading options when a trade goes in their favor. And when a trade goes against them, guess what? They shrug it off. They say, I risked $3,000. The trade went against me. I lost $1,500. Guess what? I'm okay with losing that $1,500. I don't have to get it back to break even, and I can lose $1,500 multiple times in a row and be okay, because once in a while I know that a trade is going to go in my favor, and I'm going to be able to utilize strategies like this to turn a small winner into a huge winner, and it's going to offset those small losses. But I can only be in a position to potentially hit these home runs if I make sure that I manage my losses to be a small amount. And that's how professionals trade. So if you look at any professionals trading accounts, these are the types of strategies that you'll typically see with respect to options. So again, this is hopefully eye-opening a little bit in terms of helping you understand how you can utilize options in your favor by, again, cutting losses when the trade just simply doesn't go against you, when it goes against you, either because the original thesis that you have is wrong, or that it reaches a threshold in terms of P&L. Let those small losers go. Don't let those catch you off guard and put you in a position where you're trying to turn those small losers into small winners. And because that's really when you can potentially open the opportunity of creating big losers, and then focus all of your attention on how do I turn a small winner into a huge winner, because that's what's really going to turn your portfolio around, not preventing those small losses. Preventing small losses is not going to make or break your portfolio, but when you turn a small loss into a big loss, that is when you are going to blow up your portfolio. Spend your time more so learning these types of strategies, because that's what's really going to turn around your portfolio, okay? So, actually, before I move on to cover calls, does that make sense, everyone? Please type 7 into the chat window if that makes sense. Douglas is really ahead of the curve here. I think he pressed 7 before I even asked. Okay, great. So again, this is just scratching the tip of the iceberg here. This is just one of thousands of potential examples of how you can modify or create variations of this type of trade for your trading to turn small winners into huge winners. So with that, what I'm going to do is I'm going to talk a little bit about covered calls and cash secured puts, because 40% of options volume from retail traders is covered calls, and it's important to know how to manage these positions as well. I did get quite a few questions regarding managing covered calls and cash secured puts, so I do want to cover that. So first of all, cash secured puts, I'm not going to spend time teaching you the strategy today, but cash secured puts are a strategy to help you acquire stocks at a discount. Keep in mind, cash secured puts are only used on stocks that you want to purchase. If you don't want to purchase a stock, don't sell a put option. Now, the thing about cash secured puts is that they are super easy to manage. There's really no management. Either the trade is exercised or the puts expire worthless. Those are really two only outcomes, because you're either trying to buy the stock or the put expires worthless. So from my perspective, once you sell a cash secured put, there's no management involved, because either it expires worthless, or you now own the stock at the price that you wanted to own it. That's it. Those should be your only two outcomes. If those are the two outcomes that you're not comfortable with, then you should not be selling puts to begin with. Okay. When it comes to cover calls, this is a strategy, again, that I think most of you should be familiar with, which is generating yield on your portfolio. Now, when you sell a cover call, there are three possible scenarios. So you have a $100 stock, you sell, let's say, a 110 call. The stock can either go significantly higher above 110, it can move sideways, or it can move lower. Those are your three possibilities. Now, I think the scenario number one, which is when the stock moves a significant move higher, this is really where a lot of the questions comes around, is how do you manage a covered call where the stock goes above your strike price? The answer is, if the move happens well before your expiration date, you shouldn't panic. You should typically hold on to that covered call. Wait until the last week before expiration to decide whether you want to roll this call because you think the stocks can continue to move higher, or have the call be exercised and for you to basically sell your stock at the price that you already, when you sold the call option, you were comfortable letting go of that stock. You shouldn't sell a cover call if you're not comfortable letting go of that stock at that price. But the reason that we tell you to wait until the last week is because if the stock makes a big move higher, 3 weeks or 4 weeks before expiration, guess what? It can also move back down 2 weeks later. So don't lock yourself into a loss on a covered call because you're panicking because you see this large unrealized loss on your short call. So if the stock makes a big move, wait until the last week before you decide whether you want to roll that covered call or exercise that call. Now, in the second scenario where the stock moves sideways, this is really your best case scenario. This is really where you want to let the call expire worthless and you want to rinse and repeat. And in the last scenario, where if the stock moves significantly lower, this is really the only time where, in my opinion, it makes sense to do something early, well before expiration. And that's when you want to buy back the call that you've sold. The rule of thumb here as far as when you should buy back that call is when you can buy back the call for 20% of the premium that you collected. So if you collected, let's say, $1 on a cover call, if you can buy it back for 20 cents or less, so either 20 cents or 15 cents, somewhere in this particular range, that is your trigger as far as when you want to start thinking about buying back a cover call that you've sold well before expiration. And then what you want to do is you want to maybe sell a lower call at this point. So let's say the stock declines to $95. You sold something for $1. It's now trading at 20 cents. Now, maybe instead of selling a 110 call, maybe now you want to sell maybe a 105 call and collect maybe another $1 and try to do this over and over again. So that's the general rule of thumbs as far as how do you manage a cover call and cash secured put. These are different from all the other strategies because cover calls and cash secured puts do not require you to add additional risk to your portfolio. These are the only two trades that actually reduce risk in your overall portfolio. So if that makes sense to everyone, please type 8 into the chat window. Wow, everyone's really on top of their game in terms of 8s, in terms of answering. So perfect. Okay, so what I want to do is I want to give everyone a couple of examples, and this is a good learning experience because even for myself, and this is to show you that even as professionals, that we are all human beings, and sometimes we are subject to our own emotions. So I want to bring up a trade that we made here back in April. This was Square. This was a trade that we made during the COVID-19 sell-off, where this was well before the rally kind of took place. And we were thinking that this was the markets, after the initial rally was going to roll over again. We had a bit of a push higher, but because what we really saw was that Square was getting rejected every time it hit the 20-day moving average. It got rejected again here on April 7th. And that was when I sold a put vertical. A call vertical. I sold the 50, 57.5 call vertical here. And basically what I was expecting was that Square was going to continue moving lower. And I felt that because due to the fundamentals that we were seeing in terms of where small businesses were, what type of exposure Square had specifically to the restaurant industry, physical small businesses, we felt that this was a absolute dog at the time from a fundamental perspective, and also from a technical perspective. Getting rejected that 20-day moving average was a good technical trade. So we had various reasons for getting into this trade. At the time, volatility was high, so we were selling volatility, and so we sold the call credit spread. Now, what happened was, immediately after selling that, the stock rallied, I think, $7-8 the very next day, basically hit the upper strike of our call vertical, and then spent pretty much the next few days kind of very sideways, if you will, in a very small range here above that $57 level. Now, the optimal thing to have done when we sold this call spread was to simply cut losses on the very next day, because the technical thesis was wrong. Our thesis that the stock was going to stay below got rejected to the 20-day average was basically invalidated the very next day. And this is really, I think, some of the challenge sometimes between technical and fundamental trading. And this is why, again, that I so many times continue to always use technicals in my trading, because technicals tend to be less subjective. Fundamentals are far more subjective, right? Because at the time, a few days later, the fundamentals hasn't changed. Small businesses weren't opening up. Restaurants weren't opening up 2 weeks ago, 2 weeks after this particular trade. Even up here, the fundamental still hasn't really changed at that point, but obviously the trade has gone substantially against me. So I'm bringing up this example, number one, to show you kind of, the challenges with what and I understand the challenges of what I'm preaching, right? Because it's one thing to tell you and say this is the best thing to do. It's a whole other thing to actually do it in practice. And I want to show you where sometimes our human emotional side gets the better of us, and how to go about managing that. So here is a trade that this is one of the few examples, in my opinion, where you can make an adjustment to potentially turn this losing trade into a winning trade that actually doesn't add a lot of risk. But this particular example is only useful when you're selling a credit spread. Okay, so only suitable for when you're selling a credit spread, because what I've done here is I've sold the how did I just do that? 1 second, sorry about that. So what I've done here is I've sold the $50 call options, right? So I've sold this, and then I bought the 57.5 calls. I bought the 57.5 calls. So what you could do as an adjustment here in this particular trade, if at this point you say, well, my original thesis was wrong, and now I've decided that I'm no longer bearish on Square, and because now it's managed to move back above its 20-day moving average, now I'm bullish. I think the stock can continue to move higher. If that's if let's say you find yourself in a position where you sold the credit spread and the trade goes against you, and credit spreads many times fall into this type of category, because you usually sell a credit spread near a support or resistance level. You sell a put credit spread when it's near support. You sell a call credit spread near resistance. So when it breaks above that support or resistance level, you basically can say, well, I was wrong on that trade, and maybe that completely changes your view on that stock. In this particular case, I will say it should have changed my view, but again, I took this more of a fundamental trade, and I didn't believe that the fundamentals had changed, so I stuck with this trade. And especially because a credit spread or these types of trades have limited risk, I know that no matter what happens, even if the stock goes to 1,000, I'm only risking the $4 on this particular trade, and I was comfortable risking that, so I stuck with this particular trade. But in hindsight, what I could have done is I could have said, well, you know what, things have changed here. Things are starting to move substantially higher. So what can I do? I can turn my loser into a winner by simply removing my short leg. I buy back my May $50 call option. And what I can do is I can keep the 57.5 call option. Now, here's the thing. When you do that, you are adding more risk to this trade, because if the stock now plummets back down, what you've done is you've lost all of the premium that you have in the long 57.5 calls, and you don't make any of that back from your short call. So this is one of the trades that you are adding more risk, but at that point, what you're doing is that you are finding yourself in a position where the additional risk that you're taking isn't substantial. And what it does is that if the trade does start to reverse higher and the stock continues to move higher, you can turn a losing trade you can turn this losing trade into a winner by doing this. And someone, I think, mentioned something about the Goldman Sachs trade, and that was an example that you could have created this type of adjustment to it. It's just that with Goldman Sachs, I wasn't convinced that the financials are moving substantially higher at the time just yet. In hindsight, that certainly was the case, and that could have been the adjustment that you had made, but that wasn't my thesis, and I just preferred to cut that trade, take on a loss, and move on to the next trade and prevent this turning into an even bigger loss. Now, the risk with this type of strategy is that you can turn a losing trade into even a bigger loser by doing so. So this is something that you have to be careful, because any of these types of adjustments that I'm talking about involve taking on more risk, not less, like some of the trades that I showed you before, where you're turning a small winner into a big winner. Those are reducing risk. This, in all of these examples, even though this is an example where you could have turned a loser into a winner, you did so at the risk of turning this into even a bigger loser. So credit spreads, I think, is a unique example where you can do these types of adjustments and do that. So the next example I want to give you is Zoom, right? This is a trade that we recently made. We bought the 180-210 call spread on Monday morning. It opened up at 183. I posted this trade when it was trading around 180. It opened up about $3 higher, but in 2 days, it shot up from 183 to 210, basically hitting our target within 2 days. Significantly faster than I had expected, but it did happen. So the optimal thing is to simply roll this particular trade after it hits that 210 target. So if you find yourself in a position where you bought a call option or a call spread and the stock immediately hits your target price, and you're thinking, well, this thing can continue moving higher. This thing can really, with the new information, with the earnings report coming out so strong, I think the stock can continue going higher. What you can do is you can buy back the 180-210 call option and then buy, let's say, a June 210-225 call option. Now, by doing so, what you're doing is you're taking profits, and what this does is it reduces risk of the overall trade and allows you to basically own a further upside for less risk. And this is really what allows you to do that. And if Zoom continues to move higher, you turn your small winner into a big win with lower risk. And if Zoom reverses lower, which I do think after hours it seems to have reversed lower, you're risking less than half of the risk that you took on with the original trade. So you're putting yourself in a position to really hit home runs while reducing your risk on the overall trade. So this is just an example of how you can turn a winner into potentially a substantially larger winner. So with that, what I'll do is I'll go through a couple examples real quick. I just want to show you. An example of this is we're going to cut losses on Insight. We're going to cut losses on Macy's. These are trades that are gone against us. And Insight, it lost 54% of the premium that we paid. So this is a no-brainer. I don't even have to look at the charts. You've lost 50%, time to cut your losses. But I do want to show you Tractor Supply. Tractor Supply moved substantially higher in our favor well before we originally anticipated the stock was going to hit. It hit that 120 level back on May 27th. We had the June 26th option, so we still have a whole month basically left to go here. 3 weeks left to go here. And we actually took profits on this trade, I think last week. But I want to show you is that if, let's say, you think the stock can continue moving higher, how you can turn this, what was roughly a small winner, it was about 120 or 130% win, into maybe a 400-500% winner. And what you do here is you can basically roll your position to, let's say, maybe a July option. And what you can do is you can maybe buy and add the money of 120 and sell a 135 call option. And what you can do is you can see that I can basically roll this June 26, 108, 120 call option into a July 120, 135 call option for a net credit of 30 cents. So I'm basically playing for another month in extension in terms of time. I'm playing for further upside without adding any additional risk to my portfolio for doing so. Because as you can see, this current spread is trading at $9.50. If I trade the July 120, 305, 135, it only cost me $6.05. I only paid $3.75 to begin with. So my net on this, all of this, is basically zero. So I'm basically buying this July 120, 135 call vertical for a net cost of basically flat. I'm actually taking in a small credit in order to place this trade, about 30 cents or so. So this is an example of how you can turn this 120% winner into potentially maybe a 500, 600% winner. It doesn't happen very often, right? We don't get these types of moves every single day, but when it does happen, these are the opportunities that you can take. And this is where you want, in my opinion, to focus your attention. So these are just quick examples of how you can utilize positions that we have traded in the past few weeks and see how you can use this as inspiration to understand how you can apply these for your own positions. So with that, what I'm going to do is I'm going to turn this over to Q&A, but before I do and answer your questions, I just want to remind everyone, for us to continue doing this, I really appreciate everyone taking the time out here this afternoon, participating, submitting your questions ahead of time. It really makes for a better, I think, learning experience for me to incorporate your questions into what I teach to begin with, and then allowing you to take the time to answer your questions individually from the ones that you submitted. So I want to thank everyone for taking the time out here this afternoon. I just want to remind everyone, in order for us to continue to do this, I hope that you guys consider supporting us by becoming a member, allowing you to analyze these strategies, follow the strategies, follow the ideas that we show you, and provide you with the continuing education and courses that we're putting together to help you learn and trade here with OptionsPlay. Membership is just $75 a month or $500 a year. So for those of you that are not members, I hope that you guys can consider supporting us. For those of you that are members, thank you so much for your support. It really allows us to continue doing this week after week and provide additional functionality for you guys and continue building what we have built so far. So with that, what I'm going to do is I'm going to take a look at the questions that you guys submitted ahead of time. And I'm going to try to answer as many questions as possible here. So let's go ahead.